.3%. The 30-year Treasury yield just hit its highest level since 2007, and stocks are feeling it. Hey everyone, it's Wednesday morning, August 19th, and welcome back to Capital Markets Quickie. I'm your host, Endrit Sella, here to break down yesterday's market action in just 2 minutes. Quick note before we dive in, today's episode is brought to you by AMF Capital Asset Management Frankfurt. Learn more about our funds and strategies at amf-capital.de. All right, let's get started. So, the bond market is stealing the show this week, and not in a good way. With no end to the conflict between the United States and Iran in sight, oil is staying expensive, inflation worries are creeping back, and government bond yields around the world are hitting levels we haven't seen in decades. The 30-year Treasury yield climbed to a fresh 19-year high, Japan's 10-year yield reached a 3-decade high, and even Germany's 30-year yield rose to its highest since 2011. And stocks? Well, they don't like competition from bonds. The Standard & Poor's 500 fell 0.7%. The Dow slipped 0.2%, and the Nasdaq dropped 1.3%. The real pain was in the chip sector. A closely watched semiconductor index plunged 5.5%, with memory names like SanDisk and Marvell down around 9%, and Western Digital losing 7%. Quite the reversal after their recent rally. Europe felt it too. Germany's DAX lost 0.8%, with chipmaker Infineon tumbling more than 7%, and the MDAX fell to its lowest level in over 3 weeks. Experts pointed to one simple reason. With yields this high, bonds are becoming serious competition for stocks again. In Asia, Tokyo gave back its record gains. The Nikkei dropped 2.5% as chip stocks like Kioxia sold off sharply. The bright spot? South Korea. Coming back from a holiday, the Kospi jumped around 3% to catch up with the global chip story. So today, all eyes turn to the Federal Reserve. The minutes from its July meeting are due, and with yields at these levels, every word will be weighed. Plus, retail earnings continue with lows. All right, that's it for today's Capital Markets Quickie. If you found this helpful, hit subscribe and stay in the loop. Cheerio!